Hello everyone. Welcome to Young Investors Network series on financial literacy. It has been a while, and if you have been checking our page, you could see that we have posted some videos on the basic financial analysis, some decisions that you can make in relation to savings, investments, and all that you can think of in order to gain financial freedom. As part of our financial literacy program or series, we will be focusing on analysis on listed companies on the Ghana Stock Exchange henceforth. And starting from today, we will be looking at GOIL. And then, as we all know, GOIL is an oil and gas company, or it is an oil equipment and services company, mainly focusing on trading in oil, fuel, petrol, diesel, and then it has been in operation since the 1960, with the government of Ghana being the majority shareholder, which has about 34.23% of it, followed by SNET and then BOST. Alright, so we are going to focus our attention on the trend of their gross revenue, and we will look at their growth rates for the periods, focusing on just 5 periods for now. We will look at their EBIT, that is earnings before interest and tax, that is the trend for the past 5 years. We will look at the growth rates as well. We will look at earnings after tax. We will look at cash and cash equivalent at the end of each year, the amount of cash that they had in their coffers. We'll look at their growth rates as well. And then also we'll go to the statement of financial position. We'll look at their total assets for the period that we are looking at. We'll look at the growth rates in assets. We will also look at their equity. We will look at their growth rate, and then the last that we will deal with will be their debt, their total debt. So today our focus is going to be based on just looking at the trend in terms of their revenues for the past 5 years and their growth rates, their revenue growth rates. Alright, so I have already estimated their growth rates, and then I'll have to clear them so that we'll do it from the start all over again. Let me clear all these. Okay, good. So now we can start. All right, so these figures, as we see here, I extracted them from their financial statement, so you can easily get them once you download the financial statement for the respective periods here: 2014, 15, 16, 17, and then 18. All right, to estimate the growth rate, we have done this before, and that is you taking, so let me because we need 5 years, I have hidden the good. Let me clear that of 2013 as well here. We don't really need it, but we need the figures over there to be able to estimate the good. Let me unhide those in here as well. Alright, so there we have it. So let's start. For 2014, we will need the figure for 2014, that is the current revenue. You will take out the previous revenue, alright, and divide by the previous revenue. Okay, and then one thing that I want us to add up is the cost of sales. So we'll just drag this here up to this and then extend it to the last period. All right, now we need the gross revenue. Yes, gross revenue. We need the net, we need the cost of sales, we don't need the gross. Okay, let's maintain gross profit. We need EBIT, we don't need earnings before tax, it will go. We need earnings after tax, we don't need earnings per share growth rate, and then we don't need all these, but we need the cash and cash equivalent growth rate. And even with that, we did not calculate for it, so we just select and then drag it down here. Okay, so I'll clear this. All right, so let's go down here to do same for the total assets. Okay, so we take the current year, which is 2014, and then subtract the previous year and divide by the previous year. All right, and then we just drag it. Okay, you do same for shareholders equity, so you will drag it to the last end, which is total debt that we need, and take out those that we don't need. We don't need the whole of these. Okay, total current liabilities, we don't need any of them. We don't need these. Okay, and then we don't need average total assets. We don't need these ones too. Okay, we don't need these. Good. So now we are going to chart. Let me hide this. So we are going to chart the trend for the gross revenue, net revenue, cost of sales, the gross profit, EBIT, that is earnings before interest and tax, and then you look at earnings after tax as well. So let's start. So to do this, that is to chart it, we will need to select the period in question, select what we need as well, that is the gross revenue. Go to insert. You can use recommended charts. Excel will automatically generate simple charts for you that you can use. We have a number of them. We are interested in the year and then also the revenues. Okay, so let's expose them, and then later let's edit it and then showcase. So you will change the name to gross revenue. All right, so there we have it. And then I think we should add the net revenue to it. The net revenue is the amount of revenue that the company has after paying its customs duties. Yes, and it is from that they will charge their cost of sales. So we will take out the whole of this. Okay, there we have it. And then I want us to also add the cost of sales for the period. So cost of sales, the chart will be clumsy, but we will take out some irrelevant. Good. So there we have it. Let's take out the data labels. Okay, we will bring out chart title and then term it as revenue. Okay, revenue trend, let's make it like that. All right, so there we have it. Now let me chart the growth rates alongside so that we can easily do the comparison. So just like with it, we go to insert, use recommended charts. This time round we won't use bar graphs, we will use the line. Okay, so that we can easily get to know how everything is going. All right, so we go to select data, we'll edit it, change the name to gross revenue, and then add up our net revenue after taking out our customs duties. Okay, and that is it. Then we'll add our cost of sales. All right, that is the composition of all our direct. Okay, I made a mistake. Cost of sales will be here, and then so cost of sales, we'll select. Good. So there we have it. Okay, so let's edit the chart. Well, we have our chart title, and then let's adjust the rate over here. Okay, and make it revenue growth rate. Okay, so now we can do our analysis. Let's copy them to the fresh page. Good. So let's see how the company has fared. GOIL. So that's, as we can see here, the gross revenue for the year 2014 stood at 1.6 billion Ghana cedis. Net revenue for that period stood at 1.5 billion Ghana cedis, and their cost of sales stood at 1.4 billion Ghana cedis. And in 2015, their net gross revenue increased to 2 billion, their net revenue increased to 1.9, and their cost of sales increased to 1.8. And then in 2016, their gross revenue stood at 2.6, that is from an increase in 600 million, from 2 billion to 2.6 billion, and their net revenue stood at 2 billion. That is the 600, wow, was used to pay the customs, because their gross revenue, you take out your customs duties, you get your net revenue, that is per their financials. That is how they do their calculations. Then the cost of sales increased from 1.8 to 1.88, or 1.84 to 1.88 billion. Then in 2017, their gross revenue increased from 2.6 billion to 3 billion, and in the net revenue for that same period increased to 2.4 billion from 2 billion, and the cost of sales increased from 1.88 billion to 2.3 billion Ghana cedis. And in 2018, their gross revenue increased from 3 billion to 3.6 billion, and the net revenue stood at 3 billion, and then the cost of sales increased to 2.8 billion. Now looking at the growth rate, you can see that in 2014 their gross revenue increased by 51.02%, and the net revenue also increased by 53.84%. The cost of sales also increased by 53.65%. So if you look at the growth rate of their net revenue, 53.84, and the cost of sales also increasing by 53.65%, it looks like most of the revenue goes into the cost of sales, or the direct, in costing is a direct cost, mostly made up of direct material costs, direct expenses, and then direct labor. Okay, in 2015, realized that the gross revenue also increased by 27.47%. Net revenue stood at 26.34%, and the cost of sales also increased by 26.41%. So if you look at the rate at which their net revenue is increasing and the rate at which their cost of sales is also increasing, you can say that the two of them have been increasing at very, very constant rate. Not constant per se, but same rate. In 2016, gross revenue increased to increased by 26.95% here, and then the net revenue increased by 3.78%. Then the cost of sales, at this point, it declined, or it did not increase at the same rate at which it used to increase, by 2.09%. And in 2017, gross revenue increased by 15.63%. Net revenue also increased by 21.67%, and cost of sales also increased by 22.8%. Meaning that in 2017, their net revenue, their cost of sales increased more than their net revenue. And in 2018, their gross revenue increased by 20.66%, and their net revenue increased by 24.82%, and cost of sales also increased by 23.31%. So one thing that I have identified with GOIL is that they spend a lot. They spend a lot in terms of the direct expenditure or the direct cost. All right, so they are able to raise a lot of revenue. If you look at the trend from 1.6 to 2 billion, 2.6 billion to 3 billion to 3.6 billion, that is a gross revenue. From 51, increased by 27, increased by 26, increased by 15, increased by 20%. It looks like most of the revenue goes into the cost of sales, or they spend more at that end. So there's one ratio that I want us to calculate, not a ratio per se, but it will help us to be able to look at the cost of sales to revenue. Okay, so cost of sales to revenue, you want to look at the amount of revenue that they spend, or the amount of revenue that goes into cost of sales, or the amount that cost of sales take out of the company's revenue. So I don't really have a place for it here, but we can easily calculate it for here at this end. So we will take the cost of sales for this period, that is 2014, and then divided by the net revenue for the period. So we will drag it to 2018, and as we can see, let's easily chart it so that we can see how the trend has been, and that can help explain what we are seeing over there. So let's bring it here. Okay, so let's see, we can see that, okay, data, let's use this instead. So in 2014, their cost of sales, cost of sales took about 94.3% of their revenue. In 2015, it took about 94.36% of their revenue, and in 2016, it took 92.83% of their revenue, and in 2017, their cost of sales took 93.68% of their revenue. In 2018, it took 92.55% of the company's revenue. This is where I think they have a problem. All right. So a lot will go into it because you will not know how the company generates its raw materials per se. That is from where the sources, the cost involved, the cost in turning the raw materials into finished and semi-finished goods and all that. So I think this is where they must focus their attention on for now. So for now we are done with the revenue aspect. Our next analysis will be on the earnings before interest and tax and earnings after tax. All right, so just like we did for the gross revenue growth rates and then the trend, you will select, then you take the earnings before interest and tax. All right, so we go to insert, then we take our chart, we'll come to the clustered column. You will need this instead. Okay, let's go back. Right, that's earnings before interest and tax. Okay, let's bring our data table. Okay, and then edit it by changing the series to earnings before interest and tax. That's changed it here. And then let's add our earnings after tax. All right, I'll explain the difference between the two of them. All right, so we will take our earnings over here. I think I have gone beyond earnings after tax. I have gone beyond where I should have gone earnings after tax. Okay. Okay, I think I made a mistake somewhere. Good. So earnings before, okay, it ended in 2017 or at 2017. So we go for earnings before interest and tax. Okay, so edit the year from, oh okay, it's already there, so yes. Then we'll add our earnings after tax to it. So earnings after tax to 2018. Okay, so we can bring our chart title here and rename it as EBIT / EBT EAT, sorry. Good. So now let's bring on board our growth rate. So we select, we go for our earnings before, we take the chart. This time round we go for the trend, or we go for the, okay, we'll add our data labels and then we'll rename it as our earnings before interest and tax. Then you add our earnings after tax. Okay, so earnings after tax, earnings after tax. So this will be our earnings after tax. Okay, okay, that's it. Let's take out the data labels and just make use of the chart title. Okay, so let's rename it as growth rate of EBIT / EAT. Okay, so let's pick them to this side and then do our analysis. Good. So as we can see, the revenue aspect or the revenue side informed us on the company's sales. That is the amount of revenue that they got from the trading activities. All right, now after getting your gross profit, you take out some expenses, and then after taking out your expenses, mostly that is the indirect expenses, you come to your earnings before interest and tax. And your earnings before interest and tax simply means that it is the amount of revenues that you have before you pay your interest. Interest here will be interest like finance costs. Maybe you've gone to borrow, or you borrowed from a bank, so you need to pay a certain amount of interest on it. Then the tax aspect is what goes to the government. All right, so this for GOIL. Let's look at their earnings before interest and tax in 2014, and then earnings after tax. So earnings before interest and tax, that is where we haven't taken out both interest and tax components, but the earnings after tax will be the actual profit that is attributed or that is shared between the company's shareholders and the retained, or the amount that the company will retain to undertake any profitable venture or any positive NPV. All right, so let's look at their earnings before interest and tax and their earnings after tax for 2014. So we can see that in 2014 their earnings before interest and tax was 29 billion or 29.4 million Ghana cedis, sorry, and their earnings after tax, or the profit or the net profit, yes, you normally hear net profit, stood at 20 million Ghana cedis. And in 2015 their earnings before interest and tax, mostly we refer to it as EBIT, increased to 34.5 million Ghana cedis, whereas earnings after tax, or EAT, or some refer to it as profit after tax, also known as PAT, also increased to 22.2 million Ghana cedis. In 2016 their earnings or EBIT also increased, or it increased to 42.9 million Ghana cedis, and PAT or EAT, earnings after tax, also increased to 35.2 million Ghana cedis. In 2017, you realize that earnings before interest and tax, EBIT, increased from 42 to 45 million Ghana cedis, and then profits increased to 39 million. And in 2018, we realized that their earnings before interest and tax increased to 82 million Ghana cedis, and the earnings after tax increased to 54 million Ghana cedis. Let's look at the growth rates for the periods. So realize that in 2014 EBIT increased by 56.67%, and EAT increased by 46.54%. And in 2015 EBIT increased by 17.28%, and EAT increased by 10.14%. In 2016 EBIT increased to, or by 24.43%, and EAT increased by 58.73%. And in 2017 you realize that it increased by just 5%. Earnings before interest and tax increased by just 5%, and earnings after tax increased by just 11.57%. Now let's look at 2016 and 2017. So we go back to the actual amount. In 2016 the earnings before interest and tax was 42.9 million, and in 2017 it increased by just 45 million Ghana cedis. So the difference here, or the change in here, was just 5%. So the growth was just 5%, as we see here. And in 2018, it increased by 81.7%. Wow, 81.7%. So from 5% growth to 81.97%. And earnings after tax also increased by 37.57% from 11% the previous year. Wow, that was a huge growth rate. But like I said, all these figures, the cost of sales will have a significant, or will have a huge impact on them. If the cost of sales is high, you realize that the amount of revenue that you have will be low, because you are yet to take out your indirect expenses, you are yet to take out your interest, you are yet to take out your tax. Okay, as we can see here, this is the gross. The company will have to take out its duties and taxes, duties, and then yes, duties from it. Then the company will get its net, and it is from this net that the company will take out its cost of sales. And we have already explained what the cost of sales is and what goes into it. So if the cost of sales is high, you realize that it will have a great impact on the gross profit. And the moment the gross profit is low, then it means that interest will also take its toll, tax will also take its toll. So in the end, the earnings that the company will be having, or the earnings at the end of the period, will be very low. So over here you can see that the company is having, or the company had 82 million Ghana cedis in earnings before interest and tax. That is 2018. But the company ended up with 54 million Ghana cedis as profit, or net profit. Okay, so that is that for the earnings before interest and tax and earnings after tax. Our next trend that we will look at is the cash and cash equivalent at the end of the financial year. Okay, so like we did for the previous income statement figures, we will look at the cash and cash equivalent as well, though this is not an income statement element. We have decided to include it just for us to do a proper analysis on it. So same way that we did for the rest, we'll look out for this as well. Okay, so let's go for this chart. Okay, let's edit it by changing the name. You edit it by changing the name to cash and cash equivalent. Okay, we will not add anything to it, it's just that. Let's bring up the labeling. Okay, that's good. Now let's look at the trend as well. Okay, so that's the growth trend as well. So we will take this line. Okay, let me see if I can get another line. Okay, it looks like we just have to go for this. Let's see. Okay, so let's change the name to cash and cash equivalent at the end, close, and then let the data, okay, it's just mixed up. Let's use this instead. Okay, so let's take them to the, okay, so we can use this. Okay, good. So cash and cash equivalents at 31st December. 31st December in the sense that we are looking at the end of the financial period. All right, in Ghana here, every 31st December is the end, or it's a 12 month from January to December. So the December is the final financial year. Yes, that's the financial year. All right, so this cash and cash equivalent, you are looking at, you mostly see this in the statement of changes in equity. Statement of changes in equity, where you get to see the actual statement of changes in cash flow, where you get to see the actual movement or usage of cash in the organization, what they use money for and how money comes in. So that's a statement of cash flow, sorry, not equity. So let's look at the period. This cash and cash equivalent means that you're looking at cash that the company has at hand. It can be at the office, it can be cash at the bank. Okay, so and then it can also be short-term money market instruments, financial assets that the company can easily liquidate. When I say liquidate, the company can easily sell them off to be able to get cash at the shortest possible time to be able to do anything that it wants to do. Okay, so let's look at the year 2014. So we can see that in the year 2014, the company ended with a cash and cash equivalent amount of 3.8 million Ghana cedis. As we can see here, that is for 2014. And in 2015, the company ended the year with a cash and cash equivalent which is negative 37.3 million Ghana cedis. Wow. And this does not mean that they did not have, or it simply means that the company went beyond the amount that it had in its current account. So in accounting terms, you say overdraft, or the account was overdrawn. Okay, so from 3.8 it fell to 37 million Ghana cedis. All right, and in 2016 it increased to 55 million Ghana cedis. In this case, not negative but positive. So they had cash and cash equivalent of 55 million Ghana cedis. But in 2017 it fell back to 17.68 million Ghana cedis, or 17.7 million Ghana cedis. Same overdraft, just like we explained with the 2015. So 2015 there was an overdraft, 2017 there was an overdraft. All right, and in 2018 they had a positive cash and cash equivalent of 6.4 million Ghana cedis. Now let's look at the growth rates. So we can see that all the growth rates are in negative, and the negative because the negative cash and cash equivalents here are more than the positives. So when you are looking at the growth or the growth rates over time, you realize that the negatives will take over. So as we can see, in 2014 they had a negative growth rate of 84.31%, and in 2015, just like we saw, from 3.8 million Ghana cedis to 37 million Ghana cedis negative, it is evidenced here in 2015 that cash and cash equivalent grew by negative 1,068.15%. Wow. And in 2016 it reduced by negative 247.27 or 25%. So just like we saw here, from negative 37 million to positive 55 million Ghana cedis. That's what we are seeing here. And in 2017 it reduced further from negative 247.25% to negative 132.14%. And in 2018, it increased to negative 136.3%. So this is one key thing that can also tell you how liquid the company is, because you are looking at cash and cash equivalents that the company has at the end of the period, such that in case of any eventuality, the company will have to fall on this amount of money to be able to circumvent that eventuality. So if you have a company like GOIL and you look at the trend of their cash and cash equivalent over the period, it speaks a lot about the company. Okay, it speaks a lot about the company. So that is it for cash and cash equivalent. So we move on to our statement of financial position. Like I said, we will look at the total assets, total equity, and you look at the total debts. Okay, so because they are all found in the statement of financial position, I want to work on them at once. So we will pick the total assets first. We'll insert our chart, total assets. Okay, so let me select data, edit it as total assets, then add total equity to it. Okay, then I'll add total debt to it. Okay, so total debt. Now let's clear that. Okay, good. So there we have it. So let's show the labels. Let's use the data, the chart title, and let's rename it as our financial position. Financial position. Let's rename it as such. Okay, now let's look at the trend for these three, or the growth rates for these three. So we take our date, then we take our total assets, we go to insert, and we go for that. So we'll rename our chart. All right, we'll go for total assets. Okay, then we'll go for total equity. So total equity, we will select. Okay, then we will add our total debts. We add our total debts to it. Okay, so there we have it. Let's showcase the data table. Okay, and then the charts. So we rename it as okay, so growth rate of financial position. Okay, so let's cut it and then bring them here. Okay, so all right. So now let's see. we are looking at the company's statement of financial position, and the statement of financial position, also known as the balance sheet, it looks at the company's total assets, the company's equity, and the company's debt. These three make up the financial position of the company. So the assets aspect, you look at the fixed asset like plant, motor vehicles, land, the buildings. That is for the fixed assets. Then we have the current asset. You can talk of the stock that the company had at the end of the period. You can talk of cash and cash equivalents. You can talk about receivables or debtors. These are all assets of the company. Then the equity component, we have things like the stated capital of the company, also known as the minimum capital of the company. You have the retained earnings, also known as the income surplus. We have the reserves that the company may decide to keep. And then these are some of the things that you will see in the total equity, or as we can see from here, their assets. We have plant, property, and equipment. Then we have the intangible assets. I forgot to mention that the intangible assets, the softwares that they use, the goodwill, or the good name. And these are some of the things that make up the non-current assets. And then we have available for sale financial instruments. Then the current assets, you have stocks, you have accounts receivable, also known as the debtors. Then we have the cash and cash balances. Okay, then the equity component, we have the stated capital, like I have already mentioned. They have a building fund, they have income surplus, then they have capital surplus. Then the debt aspect, we have the long term and then the short term debt. The short term debt, mostly overdrafts, as we see here. Then accounts payables. So just like we have receivables being debtors, in here we have accounts payables, that is creditors, those that we owe. Those who owe us are the debtors up there. Then we have the term loans. Then we have the long-term debt. Long-term debt, sometimes you see bonds. In here we are seeing non-current term loan. Okay, it can be a 25-year loan, 30-year loan. Then we have the deferred taxes. Term loans are all here. All right, so let's go to the figures and see how their assets, equity, and debt have fared over the period. So in 2014, we can see that their assets, total assets, stood at 340.8 million Ghana cedis, of which we have 76.8 or 0.9 of it being the equity. That is shareholders fund, another name for the total equity, also known as the shareholders fund. Then we have total debt to be 263.9 million Ghana cedis. That's quite huge. Now we move on to 2015, where we have total assets increasing from 340 to 521 million Ghana cedis, of which 93.6 million Ghana cedis is made up of equity, and 427.5 million Ghana cedis is in debt. That's representing total debt. 2016, we saw an increase in the total assets to 758 million Ghana cedis. Total equity also went up to 273.8 million Ghana cedis. Now, if you look at the total equity for the period preceding 2016, that is 93.657 million Ghana cedis, and it tripled or even quadrupled to 273.8 million Ghana cedis. Let's go and look at 2015 and 2016 equity side. What happened? That's their equity amount went that high. So 2015 is here, 2016 is here. So 93, 273. Let's look at the stated capital. It was 31 million Ghana cedis in 2015, and in 2016 it went up to 185 million Ghana cedis. Wow. So you can see that they pumped in more money in 2016 in terms of the capital of the company. Yes, in terms of the capital. So but we can see that their capital surplus reduced from 9 million to 5 million. So it's possible they took out some money from the capital surplus to the stated capital and still added more money to the stated capital, or shareholders decided to just pump in more money into it. Now this capital here, or this total equity here, yes, we say it is a shareholders fund. It is also acting as a shock absorber or a cushion, in the sense that in case the company takes upon itself a lot of debt, it will have to fall on this capital to be able to pay up most of this debt. If the company does not have enough capital but keeps taking upon itself a lot of debt, then it won't be able to, the capital in there will not be able to absorb the losses that they will accumulate, and that may lead it to being bankrupt. So that explains why I think they decided to pump in, because if you look at 2014, it was 76 million Ghana cedis. 2015 it increased to just 93 million Ghana cedis, and from 2015 onwards they decided to pump in more to 273 million Ghana cedis, and over there it increased further to 305 million Ghana cedis, of which total assets increased to 900 million Ghana cedis, and total debts increased to 594 million Ghana cedis. So if you look at it very carefully, total debt has been increasing at a very high rate, from 263 to 427 million, 484 million, 594 million to 750 million. If you look at these figures and the initial amount of equity from 2014 and 15, you realize that it was even less than a quarter of the total debt that they were accumulating. So they needed to up their game or increase the amount of equity, because you may not know, all right. And their total assets as at 2018 stood at 1 billion Ghana cedis. That is quite huge, of which 349 million is made up of equity, and 750 million of it is made up of total debt. Let's look at the growth rates. So total assets increased by 53.53% in 2014, and total equity increased by 29.59% in 2014, the same year. Total debt, so over the period it has been increasing considerably, so just like we saw for total equity in 2015, it was it increased to 21.81%, and in 2016 increased to 192.34%, just like we saw over here, 2015, 2016. Okay, so that is it. So viewers, this had been some basic analysis that we have done on GOIL as a listed oil and gas company. Today we will not go too much into it. This has been just the figures that we have made meaning out of them, looking at the growth rate, looking at the trend. Our next video will be focused on ratio analysis or accounting analysis of accounting ratio of this company. where we will make use of basic ratios, all the ratios that you can think of. In here we have liquidity ratios, we have profitability, market price, we have asset utilization, we have the leverage ratios. We will look at all these ratios one after the other and use it to assess the performance of this company. I hope you have learned a lot and you have also enjoyed this short piece. Please like our page, share and subscribe. Remember, we are trying to educate the public on investment savings. These are listed companies. If you understand these things, you make meaning out of them. You go out there, you invest in such companies and you make it out of it. Because it's not always that you have to save. Sometimes you need to invest, and some of the avenues that you can invest is to go to the capital market, or the stock market, where we have beautiful companies over there that are really performing. Per what you have seen, you can make your own judgment. This has been Prosper Apanye of Young Investors Network. Thank you.